Welcome to The Explainer. Today we're digging into a question that seems simple but has, well, trillion-dollar consequences. When the value of your home goes up, do you actually spend more money? The answer, as we're about to find out, is called the housing wealth effect, and it might not be what you think at all.
All right, let's just jump right in with a thought experiment. It's a simple idea, but it has massive implications for the entire economy.
Seriously, take a second and think about it. You get that letter, you check online, and boom, $50,000 of new equity. It feels great, right? But does that piece of paper actually change your daily spending habits? This is the core question behind a huge economic theory, and as we're going to see, the answer has completely flipped on its head.
And to really get your head around the scale we're talking about, look at this number. This was the total value of housing in the US at the end of 2008, right in the middle of the financial crisis. $25.4 trillion. So yeah, this isn't just some academic idea. It's a colossal piece of the economic puzzle.
Okay, so what is the classic textbook answer to our question? For a very long time, economists figured the link between how much your house is worth and how much you spend was pretty simple and, predictable.
Well, it all comes down to this core economic idea called the wealth effect. The logic is super straightforward. Your house gets more valuable, so on paper, your net worth goes up. That makes you feel more financially secure, which in turn makes you feel more confident about going out and spending money. Makes sense, right? And you know what? For decades, the data seemed to back this up completely. Studies from before 2008, even the ones the Federal Reserve used, basically said that for every extra dollar your home's value went up, you'd spend an extra 5 to 10 cents. It was seen as this reliable engine for the economy.
But, and there's always a but, isn't there? When economists started digging a little deeper, the story got way more complicated. Turns out we humans have a funny way of reacting to gains and losses. They're not equal in our minds at all.
So our first big clue that something was off with the simple theory, it actually comes from this really fascinating study out of New Zealand. What researchers there found was that we react much more strongly when our home's value drops than when it rises.
And this illustrates the point perfectly. The study showed that when home values went up by $1, people's spending only increased by about 2 cents. But when home values fell by $1, people slammed on the brakes and cut their spending by 4 cents. That's double. It seems the pain of losing is just a way bigger motivator than the pleasure of gaming.
Now that asymmetry, that was a huge discovery. But honestly, it was just a hint of what was coming. Because after the 2008 financial crisis, the entire relationship between housing wealth and spending didn't just bend, it shattered.
You can almost think of this story in 2 acts. Act 1, before 2008, the wealth effect is chugging along doing its thing. But then, Act 2, after the crisis, something really strange happened. House prices started to recover, people's wealth on paper started to grow again, but the spending didn't follow. The connection just vanished.
And that brings us to this number right here. This is the bombshell finding from a massive study by the JP Chase Institute, where they looked at millions of actual bank accounts after the recession. Yeah, zero, nothing, zilch. Get this, between 2012 and 2018, U.S. housing wealth shot up by an insane 50%. But the extra spending that came from every new dollar of that wealth, it was zero. The economic engine had just completely stalled. The housing wealth effect was gone.
So, of course, this is the big question, right? Why? How does a powerful economic force like this just fizzle out? Let's play detective and look at what happened.
Well, researchers have zeroed in on 3 key factors, a perfect storm, really, that work together to basically shut the whole thing down.
It really was a perfect storm. First, the banks basically slammed the vault door shut. Lending standards got super tight, making it way harder to borrow against your house. At the same time, there was this huge psychological scar. The trauma of the crash meant people no longer saw their house as a piggy bank or an ATM. And finally, demographics. The wealth itself shifted, becoming more concentrated with older, wealthier homeowners who just weren't as likely to borrow against it.
And that psychological piece, it's perfectly explained by a concept from behavioral economics called mental accounting. We all do this. We mentally sort our money into different buckets. The crisis basically caused a collective shift where people took their housing wealth out of the mental bucket labeled spendable cash and shoved it deep into the one labeled long-term security. Do not touch.
So what's the big takeaway from all this? What does it actually mean for how we should think about our own money and the economy's future?
At the end of the day, it really boils down to this.
The key thing to remember is that a rising home value isn't cash in your pocket. It's what they call an unrealized gain. It's wealth that exists only on paper until you sell your house or borrow against it. Its economic power isn't a given. It completely depends on both our ability and our willingness to turn that paper into actual cash.
And that leaves us with a final, really critical question to chew on. This housing wealth effect, it used to be a key engine for economic growth. If that engine has truly stalled out, what's driving the economy today? And maybe more personally, when you look at your own net worth, how much of it is real, accessible wealth, and how much of it is just wealth on paper?